In 2001, Enron collapsed overnight. $70 billion gone. And everyone asked the same question: how did nobody see this coming? Fast forward to today. AI companies are valued at over $1 trillion. Does anyone actually know what they're paying for? Quick history lesson. Only what matters. Enron was an energy company. In the 1990s, they told Wall Street they had invented something revolutionary, a way to trade energy like stocks, futures, derivatives, contracts so complex that nobody outside the company could fully understand them. Analysts applauded. Investors poured in billions. At its peak, Enron was the 7th largest company in America. Fortune magazine named it America's most innovative company, 5 years in a row. But here's the thing: nobody actually understood how they made money. When journalists asked, they received 65-page financial reports packed with jargon. When analysts pushed too hard, they were publicly called unethical, live on an earnings call. When employees asked whether to buy company stock, they were told, "Keep buying." 1 year later, everything was gone, not because the market changed, not because of bad luck, because it was never real. How did they hide it? There was a specific accounting trick that made all of it possible. It's called mark-to-market. Normally, companies record revenue when money actually arrives. Enron received special permission from regulators to record revenue the moment a contract was signed, even if that contract ran for 20 years and the cash hadn't moved yet. Imagine signing a deal today to deliver electricity for the next 2 decades. Enron would immediately book every dollar of that projected revenue on paper as profit. Right now, tonight. Looks incredible on a balance sheet, feels like growth. And it was completely legal. This accounting method still exists today. And when you look at how some AI companies report revenue, subscriptions billed before they're used, committed cloud spend that may never convert, projected lifetime value counted as current income, it starts to feel familiar. Not identical. Familiar. I want to be clear about something before we go further. I am not saying AI is a scam. The technology is real. The applications are real. But a real technology and a rational valuation are two completely different things. The internet was real in 1999. Fiber optics were real. E-commerce was real. That did not stop the dot-com crash from erasing $5 trillion in value. So let me show you 5 warning signs that preceded Enron's collapse. And ask calmly and seriously how many of them we are watching repeat right now. Warning sign number 1. Valuations that cannot be explained by profit. At its peak, Enron's price-to-earnings ratio hit 60. Investors paid $60 for every single dollar of actual earnings. That was considered dangerously high. Now look at this. NVIDIA's P/E ratio recently reached 220. OpenAI is valued at $157 billion, with reported losses of $5 billion last year. Let me say that again. $5 billion in losses. $157 billion valuation. When I ask how that math works, the answer I hear is, you just don't understand the future potential. That is the exact sentence Enron investors were told, word for word. The sentence didn't change, only the industry did. Warning sign number 2, the product is too complex to explain, so you're simply supposed to trust it. Enron's trading operations were a black box. Employees didn't know how the pricing algorithms worked. Analysts who pushed for clarity were labeled difficult and hostile. Try this now. Ask someone who holds AI stock to explain, in plain English, not the technology, the business model. How does GPT-4 generate revenue at a scale that justifies $157 billion in valuation? Most people cannot answer that question. Most investors cannot answer that question. And here's what should make you pause. When a company actively benefits from complexity, when confusion protects profit, that complexity is not accidental. It is a feature, not of the product, of the story. Warning sign number 3. The people who built it are quietly selling. In 2001, while Enron executives publicly told employees the stock was a great buy, those same executives sold $1.1 billion of their own shares. $1 billion sold, while telling you to buy. Now look at 2023 and 2024. Insiders at major AI-adjacent companies sold hundreds of millions in stock near peak valuations. Mark Zuckerberg sold over $400 million. NVIDIA insiders sold close to $700 million near the top. I'm not saying they know something you don't. I'm saying watch what people do, not what they say. These are two different languages, and one of them is honest. Warning sign number 4. Regulators are years behind the product. The SEC approved Enron's mark-to-market accounting in 1992. They didn't understand the derivatives market well enough to see what was being hidden in plain sight. By the time anyone figured it out, $70 billion had vanished. In 2023, a United States senator, one of the people charged with overseeing the most powerful technology companies on the planet, asked Mark Zuckerberg how Facebook makes money. Zuckerberg answered, "Senator, we run ads." These are the gatekeepers of a $1 trillion AI industry. When the people watching the gate cannot describe what the gate is for, the gate is open. Warning sign number 5. And this one is different. This one is human. Enron's CEO Jeff Skilling appeared on the cover of Fortune magazine. Brilliant, charismatic, absolutely convincing. People didn't invest in Enron. They invested in Jeff. Sound familiar? Sam Altman is one of the most interviewed, most celebrated executives in history, leading a company that has never generated a profit. Elon Musk's ventures attract trillion-dollar narratives not always because of what the product has done, but because of the name attached to it. When the story of a company is the CEO, not the business model, that is not an investment. That is a bet on a personality. And personalities change. Personalities fail. Personalities disappear. So, is AI the next Enron? Here is my honest answer. I don't know, and neither does anyone else. But that's not the right question. The right question is this: are you making decisions based on evidence or based on a story that feels true? Enron's investors were not stupid. They were human. They heard a narrative that made sense. They saw numbers that looked real. They trusted people who appeared confident. And they lost everything. Not because they were reckless, but because they were in a moment that looked exactly like this one. The 5 warning signs I've shown you today: valuations without profit, business models nobody can explain, insiders quietly selling, blind regulators, CEOs elevated to icons. These are not predictions. They are patterns. And patterns do not announce themselves. They repeat quietly until enough people learn to recognize them. History doesn't repeat, but it rhymes. And right now, if you listen carefully, you can hear it. If this video made you look at something differently, share it with someone who's excited about AI stocks right now. Not to scare them, to start a conversation. In the next video, I'm giving you the exact 5 questions that, if asked in 1999, would have saved Enron investors $70 billion. Subscribe so you don't miss it. And drop in the comments. Which company today do you think is the most overvalued? I read every single one.